Hello, everyone, and welcome to another event hosted by the Cambridge University Social Impact and Sustainability Society, or CUSISS for short. My name is Navin Seeterram. I am the Social Impact Director and Events Director at CUSISS, and I will be one of the moderators for this session. Today, we are honored to host a fireside chat featuring the pioneering philanthropist, venture capitalist, and social innovator, Sir Ronald Cohen. He will be chatting with us President Michael Williams, discussing the impact revolution, reshaping capitalism to drive real change. I would also like to acknowledge the help of our friends at the Cambridge Venture Capital and Private Equity Society for the considerable efforts in helping us promote this event. If I may ask you to bear with me to cover some housekeeping items for this event. If you haven't already done so, please ensure that your microphones are on mute for the duration of the session. Also, please send all of your questions directly to me using the button at the bottom of the chat window. Please do not type your questions in the chat window. Look for the send message at the bottom of the chat window, find my name, Navin Seeterram, select it and type in your question to me as a direct message. I will read those questions to our panel during the Q&A session. There are many of you on the session, and we promise we will do our very best to get to as many questions as we can get to just before 7 p.m. Greenwich Mean Time. I am now pleased to pass you on to the main event with Sir Ronald and Michael. I will tell you a bit about Michael, and he will tell us more about Sir Ronald. As most of you know, Michael is the founder and president of our society. He is also the founder and managing director of Highgard Capital, and he's one of the world's best performing hedge fund managers of the past decade. So he is well versed in the investment industry. He is also the founder and executive director of a US-based not-profit called Oasis, which also focuses on ESG, environmental, social, and governance principles. And with that, I will turn it over to Michael to introduce our featured guest, Sir Ronnie Cohen. Michael, over to you.
Thank you, Navin, and welcome to everyone joining us from all over the globe. Actually, we have people from every continent on this webinar so far, except for Antarctica. And at last count, from over 20 countries. So we're excited to have such a great attendance and such far-reaching spread on this. And please welcome our esteemed guest today, Sir Ronald Cohen. I'll tell you a little bit about him, and I will direct you to his website to learn even more about him, because we could easily discuss his biography for the next hour, which we certainly want to hit the highlights of that, but discuss impact investing. So. But Sir Ronald has a great story of success. He immigrated with his family as refugees from Egypt to the UK when he was 11 years old, with little money and even less knowledge of the English language. He rose from those humble beginnings to graduate from the University of Oxford and received an MBA from Harvard Business School. At age 26, he co-founded Apax Partners, which would become one of the biggest and most successful venture capital and private equity firms in the entire world. At last check, Apax managed over $50 billion, not too shabby. He leveraged that drive and success to become a pioneering philanthropist and social innovator, which is what we're here to chat about today. Sir Ronald was awarded a knighthood in 2001, and he is well known as the father of impact investing and the father of British venture capital. He currently serves in several leadership roles in a number of impact investment and philanthropic organizations, including as chairman of the Global Steering Group for Impact Investment and the Portland Trust. For the sake of time, I'll let you read more about him, as I said, on his website, which is impactrevolution.com. Again, impactrevolution.com. We'll put a link of that on the YouTube. When we post the recording on YouTube, we'll put links to all of this. His story is truly remarkable, and his personal impact on investing with purpose has had enormous positive ramifications across the globe. And if that wasn't enough, he's also the author of several books, including The Second Bounce of the Ball, and most recently, Impact, Reshaping Capitalism to Drive Real Change. This is the book. I encourage you all to read it. It's very informative and a good, solid read. So, Sir Ronald, welcome. You're a very, very busy man. Thank you so much for carving out a bit of time for us today. I know I speak for not only myself, but for every one of our society members and everyone joining when I say we're very excited to have you in our event today. So welcome.
Delighted to be here with you, man.
So jumping right in and kind of tailing on the end of your intro of the bio there, your story from an 11-year-old refugee with no money and no real knowledge of the English language, to becoming a godfather of impact investing in the venture capital world is a tremendous story of perseverance. So getting in the Wayback Machine for a second to coming out of Harvard Business School, you worked in McKinsey for a few years, which is a great company, and you could carve out your own ticket in pretty much whatever career you chose with those ticks on your CV. So why at the ripe old age of 26 did you decide not only to start your own business, but to start a business in venture capital, which in the 70s was virtually unknown at the time?
So, Michael, like many of you on this webinar, I sense that something fundamental was changing in the world. What I saw when I was at business school in the US was the birth of technology companies led by young people, and the notion that small was going to be beautiful resonated with me. It seemed to me then that with all these new approaches, big companies that had been established leaders for a century or more were very unlikely to run as fast as these agile entrepreneurs. And so I happened to be at business school at the right time and to listen to a presentation by one of the first venture capitalists, General Doriot, an unlikely figure for a venture capitalist because he was a French general who had gone into the venture capital business. And he explained that he had invested in a company called Digital Equipment. He put $70,000 in, and the company was going to go public, and he was going to collect $100 million. And that caught my attention. I thought, well, here is a way in which I can make myself financially independent, while at the same time doing something useful for society, creating jobs in new companies.
Interesting. And so you founded Apex in 1972. And we share a similarity in the alternative investment space. At the 10,000 foot level, your mandate as a venture capitalist was no different in 1972 as it was in the 80s and 90s, as it is now for me as a hedge fund manager. We are paid to effectively see things before they happen and then translate that crystal ball into profits for our investors. Coming out of the 70s, you and Apex were on the vanguard of the tech revolution, as you just mentioned. You made early investments into some of the biggest and most successful and most influential companies in the entire world. Can you recount a little more of how you saw that revolution, that tech revolution coming before most other investors caught wind of it or really knew that it would be what it might become and what it obviously has become?
So I suppose you start off in a new field and you have to build the field as you build up your firm, Michael. And you look for evidence that you're on the right path. So we began to develop a deal flow. At the beginning, it was very, very difficult. People in the UK weren't attuned to the idea of entrepreneurship and risk-taking, and British culture wasn't very forgiving if you failed. And so they were quite difficult years, but we could look at the United States and we could see the beginnings of a real revolution with the arrival of the PC and software companies that were writing software for Apple. And so you began to think that something really important was changing. So that gave us confirmation that our initial view was right. Now, as you know, the investment business is a tough business. Performance is the product, and it takes years to prove your performance. And so fund after fund, our portfolios looked more promising. The track record became better entrenched. and it became easier to raise money. But the first few years were very difficult indeed, and the majority of people thought we were crazy.
Interesting. And as it goes, anything new is initially shunned, and until enough momentum catches, and then the tipping point to where everybody suddenly wants it, and the wave comes. So now, coattailing on that a bit, let's look at that same kind of tech revolution through the lens of impact investing. So as you said, the world has to be in a certain state of mind, if you will, the world had to be in a certain state of mind back then. As you're shaping that industry, and as those companies are sort of taking over the world, frankly. But with the world in that state of mind for the tech revolution to catch fire, what similarities or indicators do you see in today's world that might make it primed for an impact investing revolution?
Well,
going forward?
I have a sense of déjà vu, Michael. I think a lot of people on the call, possibly every person on this webinar, has a feeling that things can't continue as they are. We can't cope with the social and the environmental consequences of our system. Something has got to change. And so the change that is coming along has become very visible now. It wasn't so visible 20 years ago when I first set off on this path of impact investment. But today, you can look at ESG investing, environmental, social, and governance investing, as you know, of more than $30 trillion, equivalent to more than 30% of professionally managed assets in the world, which is seeking to achieve impact as well as profit. Now, that isn't a flash in the pan. That's the beginning of a mega trend. And if you look at impact investment proper, which has the same intention as ESG, but in addition measures the impact created, it's going to hit $1 trillion this year. $1 trillion, that's the size of the world's venture capital pool. So there's beginning to be real evidence now that what is in the air is that companies from now on are going to be judged on their performance, not just in achieving profit, but in achieving impact. And the question for everyone on this webinar, as they think about their careers, is where do I fit in with this? If I believe this is going to happen, and if I want to be an investment manager like you and me, what type of investment management do I want to do if it has to deliver impact as well as profit? Is it in venture capital and private equity and hedge funds? Although, I mean, in hedge funds, it's an interesting question I'll ask you, is how is impact going to affect the hedge fund industry? But leaving hedge funds aside for a moment, across alternative assets, we can begin to see impact property funds as well as impact venture capital and impact private equity funds, impact infrastructure funds too. And then the ESG money, if it is going to shift now to become $30 trillion worth of impact investment, because as I write in Impact, we're going to bring in the next 3 to 5 years impact transparency to every company's activities, then do I want to be managing ESG stocks, which have outperformed all stocks so far this year? Or do I want to focus on a particular aspect of delivering impact as an entrepreneur? The clean tech index is up 100% so far this year. Do I want to be a clean tech entrepreneur? Do I want to create a venture like that can become a Tesla in the future? And if I want to work for a big company, similarly, how do I identify a company that has an impact mission? How do I contribute to it? So I think it's exactly the same type of change that came with the arrival of technology.
So you discuss in your book shifting the business model of risk return to risk return impact. So and you've hit on a couple of these notes so far, but what can we as stakeholders, investors, entrepreneurs do to pressure companies and other stakeholders and other investors and other entrepreneurs to shift that paradigm from the risk return model to the risk return impact model, and focus as much on that as we do on risk return, and basically what that boils down to is profitability. How much am I going to make versus how much do I stand to lose?
Well, Michael, the answer is every one of us has a role to play as a consumer by buying only the products of companies whose values you share. As an employee, similarly, picking companies that have the same values you have. As an investor, focusing on sectors that can deliver impact and defining investment strategies that maximize impact as well as profit. So every one of us has a role to play in this revolution. But I think what is important about this revolution is that it started with people thinking that impact had to do with philanthropy, didn't it? Everybody thought, you hear the word impact, if you want to do good, then it's philanthropic and you won't do as one. And what we're beginning to discover is that actually, because of these changing consumer preferences and talent preferences and investor preferences, it is actually better today, if you want to make money, to optimize risk-return impact than to try to optimize risk-return alone. Let me give you a couple of examples. If you look today at companies in the fossil fuel area, I'm not in favor of investing in fossil fuels. You may have been selling short their shares. I don't know, but let's assume that you look at fossil fuel companies and you want to compare them because you feel they have some place in your portfolio. You look at a company like ExxonMobil, which, as I describe in the book, creates $39 billion worth of environmental damage from its operations alone, without the damage caused by the oil it takes out of the ground a year. And you compare it with its competitors, Shell, which is bigger and delivers 23 billion of damage, and BP, which is about the same size and delivers $13 billion of damage. Now, as an investor today, you'd have to be very foolish to invest in ExxonMobil. And indeed, the market capitalization of ExxonMobil has gone down from 500 billion 3 years ago to about $130 billion today. Why? Because it's doubled up on being a fossil fuel company. It refused to see the importance of clean energy. So as an investor, you do better by achieving greater impact by investing even in a bad sector in companies that are transitioning away from fossil fuels towards clean energy. Now, at the same time, if you're an entrepreneur today and you create a new venture and it delivers a product that is clearly appreciated because it is helping certain sectors of our population, you will attract talent more easily, and you will today begin to attract money more easily. Up until now, it's been difficult because of this connotation of impact somehow being philanthropic. And look finally at a company like Tesla. Now, Elon Musk didn't go into the automobile industry because he thought that industry was welcoming of new entrants and there was great opportunity there. Right. He went in because he wanted to shift the industry away from the combustion engine. And he thought he could create an even more successful company based on electric cars. And what's the result? He is today worth more than any of his competitors. Why? Because consumers don't want to pollute. Previously, they weren't aware of it. Now they're seeing fires and floods and deforestation, and they don't want it. And so consumer preferences help you. So I think the really important thing to notice today is that optimizing risk-return impact is actually a better way to invest and a better way to do business.
So do you think from a standardization and the metrics of that, is it showing those impacts on balance statements and financial statements from big companies like an Exxon that may make $100 billion, but do $101 billion in damage at the end of the year? So the balance is they're negative. They're actually causing more damage than they're doing good in the world. And we don't necessarily have, unless you dive pretty deep into the research or read great books like Impact, it's hard for kind of the common investor to see that. So is it to make that more available and transparent? Is it just putting it on balance statements or putting it on the financial statements of the public companies and even the private companies?
So you're asking a very important question, because if you look today, Michael, at what ESG investment is using to make its decisions, it's using reporting of tons of carbon, voluntary reporting, unaudited numbers, numbers which companies have tended to pick selectively, picking the good numbers and the things they're doing and leaving out the bad ones. And it's $30 trillion, so it's a heavy chunk of capital today. And if you look at the Harvard Business School data coming from the Impact Weighted Accounts Initiative, which you can all access on the HBS site, you see that in the 1,800 companies whose environmental impact the initiative has published, you see that 250 of them create more environmental damage in a year than they make profit. You see that more than 600 are creating environmental damage equivalent to a quarter or more of their profits. And that taken all together, these 1,800 companies create $3 trillion worth of damage. Now, how have we been able to bring these numbers to life in this way? Well, we've used the metrics that have been around in the environmental area for a number of years now, voluntarily, generally provided by companies. And we've used computing power to gather that information, and then we've defined pathways to monetizing it. What is the best price for a ton of carbon emissions? And we've done that for a myriad environmental and social issues. And so we've been able to express it in monetary terms. And as you mentioned, once you do that, you can express it in the P&L statement of a company and even on its balance sheet. And so you begin to realize that technology makes it possible for us in the 21st century to measure the impact of a company almost as dependably as we measure its profit. And this puts us at a historic crossroads, similar to that our predecessors were at after the crash of 1929. when investors snapped up and realized that they had been investing in companies without transparency on the profit companies make. What do I mean by that? Every company could pick its own accounting principles. There were no auditors to verify the numbers. And the accounting rules enabled you as a company to squirrel away money in hidden reserves without even telling shareholders. And so there was a wake-up call, and only 4 years after the Great Crash, the US passed legislation, securities legislation, to introduce GAAP accounting and auditors. We're at a similar crossroads today with regard to transparency. We can see that it is possible for us to measure and to monetize impacts and to reflect them within financial accounts. And I think because you can already see in that Harvard data a correlation within several sectors between companies that pollute more and lower stock market multiples, lower valuations for them relative to their competitors who pollute less. I think it's become inevitable that regulators are going to have to step in, because regulators have to maintain a level playing field for all investors. And some investors know how to go to the Harvard Business School site and other sites and find impact information, which is price sensitive, and others don't. And so it seems to me it's inevitable now, Michael, that as this information gets used more and more, regulators step in and mandate that companies publish impact-weighted financial accounts. And you can see, again, you were talking about looking further than the headlights on a darkened road, which is how I always viewed it at APAC. So you have to develop that ability. But you can see it now being expressed, not just by people like you and me, but expressed by the organization that brings together all securities regulators, by the organization that's responsible for setting standards outside of the United States in every country, by the World Economic Forum, by the International Federation of Accountants. Now, you don't need that much evidence to understand that something major is shifting when all of these organizations are beginning to address the issue of sustainability information and sustainability accounting. And what you have to do in trying to look further than others is to understand what the destination is going to be. And you're right. The destination is going to be reflecting impact through financial accounts, because investors are familiar with the tools of financial analysis and can use them on impact-weighted numbers.
And you bring up a good point, and I wonder if there is what the inflection point will be. To going back, the Great Depression was certainly an inflection point for the world. And out of that, we got Sarbanes-Oxley and in the US, and as you eloquently stated, the financial reporting of companies. And I look at that in the alternative space, that coming out of the Great Recession of 2007 and 2008, the alternative space changed night and day, because we didn't have the audit and the transparency and the administrators and the accountants in that industry that we do post Bernie Madoff. Frankly, it took a Bernie Madoff and a half a dozen other crooks to make changes in that industry. So going forward, now that we are 11 years out of that, that's generally the 10-year mark is kind of when the revolutions kind of happen, when the big changes take place. So I think we're primed for that from companies maybe self-reporting to the point, like you said, where the regulators say, you know what, enough of these companies, and there's enough momentum coming here that let's make this a standard. And let's define one of the things I think that hasn't been done quite yet, and the Harvard group that you mentioned, and we'll put a link to a Harvard Business Review article that Sir Ronald co-authored that discusses this a bit. But they're getting towards standards. But when you have companies out there, as you said, saying, well, our board is diverse, so we are ESG friendly, because we have 20% of our board are women or minorities or both, but also never mind the fact that, we just caused $30 billion worth of damage to the environment but focus over here and not over here. So making standards that companies have to follow. And look, as an alternative investment guy, the last thing I want is more regulation, and as a good old-fashioned American as well, I guess. But at some point, you have to bring in the regulators to just standardize these things and have people, and they can choose not to report them in the initial stages, but you know what, they're gonna pale in comparison to the companies that do report them, and the money will flow in that direction to the companies that say, here's complete transparency, not just look at our great board and our terrible environment impact, but look, we're not so good at environment, but we're great on the board, or vice versa, and we're working. We're trying to get better every day. And that resonates with people, that resonates with customers and investors alike. So my last question, and quickly, and I want to turn it over to the audience for a Q&A session here, but how do you stop? We've both been in boardrooms where giant investors, the institutions of the world that write 100 million, 500 million, $1 billion checks, and they go on CNBC and they go on Bloomberg and they go on the BBC and they say, we care about ESG and we care about the world. But behind closed doors, they say, Ronnie, Mike, we need to make money or I'm going to lose my job. So yeah, if we can make money investing in solar panels, great. But at the end of the day, we need to make money. And forget what I said in the Wall Street Journal last week. So how do we transition that from impact washing to these monster investors who are, frankly, I hate to say this, but it's very true in many aspects of, they are more concerned with self-preservation and protecting their jobs and their roles than they are about doing good in the world, when they don't realize necessarily the longer term out in front of those headlights in front of the car, as you mentioned. Yeah. If they focus on the longer term, they will only improve their station with their company and with the entire industry. Back to the question, how do we stop the impact washing and where behind closed doors, people don't necessarily focus on it as much as they say they do?
Okay, so nothing focuses the mind like a 2/3 drop in your share price. Okay.
Very true.
What is going to change is that these consumer preference changes and these talent preferences changes are leading investors to shun certain companies. They won't invest in companies that believe in continuing to do exactly the same thing and keep polluting. They're prepared to engage with companies that have transition plans for improving their performance, not just, by the way, environmentally, but socially as well. The figures at Harvard show the cost of diversity or lack of diversity for Apple is $2.7 billion, taking missing numbers of people from excluded communities and describing the salary levels to them that they would have earned had they been employed, and looking at differences in gender pay, other pay, and so on. Compare that with Costco, which has twice the number of employees that Apple has in the US, 80,000 for Apple in the US. Costco's charge for diversity is $1 billion, right? Even though it's twice as large. So the first point to make is that investors are now judging companies not just in terms of their profit, but in terms of their impact performance on the environment and on people through their operations, through their employment, and through their products, because they view these as impacting not only the future profitability of companies, but their values today. And so it's not a coincidence that you see shareholder rebellions starting now.
Mm-hmm.
When you're saying what's going to change it, when Procter & Gamble at its shareholder meeting has 67% of shareholders complaining about the deforestation it's creating because of its use of palm oil, and asking management to provide detailed information about it and change its behavior, something is happening that is going to change things, and you're going to get the same rebellions around diversity and racial discrimination. What the COVID crisis has done is to bring these social issues now right to the surface. They existed before COVID, the Gilets jaunes and the Chilean rebellion and the Lebanese rebellion, and then you had Black Lives Matter. And people began to understand that this is not sustainable anymore. We have to deal with the issue of racial discrimination and inequity in the system. So the mechanism for changing it is through the investment world. Investment is the lifeblood of the capitalist system. And so it's not surprising that this revolution is expressing itself through investment now. So we're going to see these rebellions multiply. And when investors begin to ask companies for transition plans, which have to be approved by shareholders, the issue of measurement is going to come into even sharper focus. Because unless companies commit themselves to measurable objectives, and unless you can plot them in terms of their impact-weighted profit, it's going to be very difficult for shareholders to keep track of the impact performance of a company. So what you were referring to as increased regulation, which is increased transparency, really, is going to happen because investors are going to be demanding it, and regulators will have no choice but to provide it, so that every investor has access to the same information.
And that's a good point. And I mean, that's frankly, one of the goals of our society is for our members and anyone that joins our events like this, is to not just, close your laptop or turn off your computer and say, wow, that was pretty entertaining or informative, but to close your laptop and go start making these changes, big or small, into voting with your wallet, and investing in the companies or buying the products and services of companies that are more transparent, that are making efforts to be better in this ESG environment. So very, very understood point there. And I challenge all of us, myself at the top of the list, to do better of guiding these companies and our own companies in that better direction. So with that, we're a little bit over on our kind of our chat. So I want to open this up. We've got a couple of hundred people that may want to chime in with some questions. So Navin, I'll turn it back over to you to kind of ask questions and see where we go from there.
All right, sure. Thank you very much, Mike and Ronnie. All right, so I would say the first question we have quite a lot of questions, and they're all very, very impressive. So I will do my best to find, which questions I could get going. So, so let's start with this one. This is from Xavier Parkhouse Parker. At the moment, the biggest trend in venture capital, private equity, and investing is the rise of special purpose acquisition companies. Is it possible for this investing innovation to be applied into ESG and impact investing?
Absolutely. There already is an impact SPAC launched $400 million, launched by Bridges Ventures and AEA, which is a big private equity house in the United States. Absolutely. I would encourage you to think of SPACs as ways of purchasing companies, enabling companies to go public that are able to deliver even more impact than they're delivering today. So you don't need to start an impact venture from scratch. You can pick a company that is in a field and operates in a way that delivers impact, and contribute to doing that.
Okay, great.
And I'll chime in on that quickly, that the entire industry, the alternative investment industry from VC, PE to hedge funds is segueing away from investors putting their money into closed door funds, black box strategies of, hey, write us a check for $10 million and we're going to go and do some great things with it. And we're going to send you back 20 times your money in 10 years. That's kind of the old VC model. Now people want more transparency with the information age. They want more up-to-date reporting. And what that has led to is more individual investments of the SPACs, for those that don't know it, are special purpose investments. You raise money for one specific investment. And that's where the entire industry is going. So certainly doing that in the ESG space and impact investing space is right in line, which is a great thing. You can ride the wave of the entire industry with that ESG focus and not feel like you have to revolutionize the industry in what you're doing. So
Right.
Yeah.
All right. And this is from Christian Buka. This is for Ronnie. Do you believe the circular economy will be a major driver in the transition towards a more sustainable economy? And if so, which do you think are the most significant barriers that deter the implementation of the circular economy?
I totally think that the circular economy is part of this whole trend that we see. The most important element, in my view, in achieving it is the transparency we've been talking about. Because otherwise, companies begin to design products that are partly recycled and you don't know where you are. When you have real transparency on the product impact of a company and on the impact that comes from its supply chain, then you can begin to plot the circularity of a company's operations.
All right. So there are a few of some of the questions there. Some people were very determined to get this to you because they were put in the registration from before and they've actually repeated them and refined them here a bit more. So I have to get to them. So this is from Warasami Ismail. Is effective altruism more pragmatic and impactful compared to impact investing?
I don't know what effective altruism means, but I'll interpret it to mean philanthropy that uses impact approaches, such as those that are defined in the book and are therefore more effective than grant making. So I don't think they're alternatives one for, I don't think they're mutually exclusive alternative. Philanthropy has a very important role to play, but it's about 1.5 trillion out of more than 200 trillion of investable assets in the world. So it has a limited role. Relative to investment proper. I think, as I say in the book, philanthropy should really be the flag leaders. It should really be the flag leader of this whole movement. Philanthropy hasn't completely got on board, although many foundations now understand impact and are implementing it through investing their endowments and through using pay for success approaches in their grant giving. But we have to change our whole economy to creating profit and solutions to our big challenges, social and environmental, instead of creating profit and creating damage, untold damage.
Okay, we have another question again. This is asked twice again. This is from Mr. Oriol Ruiz from New York City, Vista Alta Impact Investments. He asks, any insights of why Latin America is lagging so much in the impact investments compared with Africa or East Asia? And any advice on how to change dynamics in those regions?
So I see Latin America becoming a very important area for impact investment. Within the global steering group for impact investments, 33 countries, we have almost every Latin American and Central American country. I think what's happened is that the countries like Brazil and Chile and Argentina, for political reasons, have found themselves bogged down and unable to pursue the strategies that had already been started. Brazil had made very promising steps in this direction. But if you're interested in being involved in Latin America, then just send me an email and I'll connect you with my Latin American colleagues.
All right. So I guess if you guys were to email me at events, I will look to patch you all into the network if need be, right? So this is from Pippa Stevens, and Pippa has gone all in with 2 questions. Do you see any prioritization amongst the broader impact investment market between E, S, and G? And that's 1. Second question is, do you see any sectors which are notably exempt from the impact revolution?
So on the first, I think it is very important that we put equal stress on E, S, and G. The reason is that if we don't, we will have, let's assume that we only provide impact accounting transparency on environmental. You'll have companies saying to you, sure, I look terrible here. My sector is a high pollution sector and I'm in the middle of it. But think of all the great things I'm doing in terms of my employment impact. And if you don't have the numbers, then you won't be able to make a judgment. So from that perspective, as investors, we want all 3. The second thing is that as we begin to design strategies to improve E, S, or G, we have to make sure that we don't worsen the other 2. So you can have environmental steps that you take that improve your pollution level and create terrible employment issues. You have to find ways of optimizing these different impact areas.
Okay.
And the second question was?
Oh, the second question was, if I get back there from Pippa. Do you see any sectors which are notably exempt from the impact revolution?
I think there are some sectors which haven't been touched by tech yet. So I'm sure there will be some sectors that are going to lag. But interestingly, the impact revolution may accelerate the arrival of tech in some sectors, which so far have been, I think exempted may not be exactly the right word in the case I'm about to take. But let's take banking. Mm-hmm. We have not seen banking disrupted by the tech revolution yet. We haven't seen platforms that are looking at credit risk in imaginative new ways, that reduce the cost of funding, because overdraft funding, which is so expensive for vulnerable people, for instance, is part of the existing banking business model, but not necessarily of a future digital banking business model. And I think what you're going to find, and it'll depend on the entrepreneurs, like many of you on this webinar, who decide to tackle specific issues, you will find some areas that are going to be tackled earlier than others. I can't think as yet of any areas that should necessarily be exempted from this, I must say.
Fair enough. All right. Next question here is from Simon Pullman Jones. And Simon asked, reporting of sustainability damages, climate, pollution, etc., is demonstrably possible, and the benefits of extending this through regulation are clear. How can broader scope of impact, such as the issues covered by the UN SDGs, be similarly brought within the scope of corporate reporting?
Excellent question, and you'll be very happy to hear that the Impact Weighted Accounts Initiative enables you to link every impact line to one or more SDGs. It's very important that we use the magnet-like quality of the SDGs now in terms of public opinion and opinion within companies, and connect it to this effort to bring transparency to impact. In fact, the only way to achieve the SDGs is through the changes I'm talking about. If we need to bring $30 trillion over this decade to achieve the SDGs by 2030, the only place you can bring it from is companies and investors. And so if you think in terms of turning 30 trillion of ESG into impact investment, where the impact is measured and connected to the SDGs. If you take the equity markets, 100 trillion, and you think that 30 or 40 or 50% may actually be engaged within this decade in publishing impact-weighted accounts, publishing transition plans, both for environmental and for social. If you think the bond market, about 80 trillion, if you think 10 or 20% of that can go to green bonds, where the interest rate depends, as we're seeing increasingly, on the achievement of the environmental objectives that were set, a lower interest rate if you achieve the objectives. Blue bonds for the oceans, brown bonds for the soil, education bonds, and so on and so forth. You know, that's another 20 trillion. And then you have private equity and venture capital and so on. If you think a third of the alternative assets pool would also go in the direction of measuring impact, you get to 40, 50 trillion dollars. And that's the only way of achieving the SDGs, to change the behavior of companies so that they deliver social as well as environmental improvement.
All right, just to move on along, sorry, there's a great response around. Let me just, so from Matt Wonderley asks, what can early stage startups do to make impact and sustainability as a part of their company's DNA?
So early stage companies have to define, if they want to be impact ventures today, which is what I would be trying to do if I were 26 today and wanted to be an entrepreneur, business models that deliver greater profit and greater impact together. So find an issue that you're passionate about solving and define a business model that achieves that. If it's a fintech platform running on a mobile phone to enable people with no money, but a decent credit history, not measured according to the lending they have had, but according to the commitments they have made and how they have honored them, and so on and so forth, in terms of payment of their rent or other commitments. If you begin to find platforms of that kind, the greater the number of users you have, the more money you will make and the more impact you will deliver. So the key, as I mentioned in the book, the key is to define a business model that optimizes risk, return, and impact.
Mhm. Right. I have one question here for the panel, which is what key attributes would the panel like to see consistently measured in these impact reports? This is from Maduka. So the question again, what key attributes would the panel like to see consistently measured in these impact reports? Or impact reports, I would imagine.
What key measures do we need for consistency in
Yeah.
impact reports?
Yes, in
So
impact reporting.
you need standardized metrics.
Mhm.
So you need standards for measuring metrics on emissions, on employment, and so on and so forth, in tons of carbon, if you like. And then you need standards for monetizing those metrics. Now, interestingly, the organization that's responsible for accounting outside of the United States is having a consultation now exactly about these issues. Should it set up a sustainability accounting standards board alongside the financial accounting standards board it has? And that's the task. The task is to standardize. It's no different in nature than the task of generally accepted accounting principles, except this time it's going to be around generally accepted impact principles.
I agree 100%. I think what we've seen in kind of the first wave of the ESG movement is reporting. And you have plenty of companies and nonprofits that are out there sort of measuring and benchmarking and saying, you know, by our standards, these companies are doing good, but it's all self-reporting. There's no accountability, very, very little accountability to, dare I say, no accountability. So it becomes defining what those measurements will be and what those and standardizing those measurements. And ESG is such a broad scope. I mean, even just in the environmental alone, there are tens of thousands of different metrics that could be measured and put on a balance sheet or financial statement. So what it's going to take is just somebody doing it. And it could be an Apple that's a major player in the world, and it could be a nonprofit. You know, it's one of the things that my nonprofit is trying to kind of focus on, and it's just a monumental task. But climbing Mount Everest, you don't leap up there. You take one step and you take another step, and then you're at the top eventually. So one step at a time, of course. And that's what I see these standardizations becoming, is somebody, either a company, individual, a nonprofit, a group of any of those or combination of any of those, saying, here's the flag planted. These are the standards that we are using going forward. Would you like to join us? Yes or no, or help us? You know, if the standards that we have set to are not, the world doesn't like them, give us feedback. But it's going to take just somebody doing it, as opposed to just kind of the impact washing of so many companies that their hearts are in the right place of measuring these things. But so much of it is self-reporting from companies that, again, like we discussed earlier, they may be doing great in one aspect of ESG and they may be completely failing in another aspect, but the world never sees both because there are no defined metrics and there's no accountability to hold their feet to the fire of
Right.
all of those standardizations and the matrices. So just concurring with what Ronnie said of defining those standards and then holding companies accountable to those standards. And that can be back to what we were discussing of, all right, well, how do we hold them accountable? Well, you vote with your wallet. You know, you use their products and services, you make investments into their companies. You go on Twitter and say, quit killing baby seals, and you know, you need more diversity in your board, and call them out. So there's a carrot and a stick element there to accomplish those goals. But standardization and accountability are the first two that I think.
Yeah, well said, Mike.
All right. On that note, I would have to close off the Q&A session as we're just over past the hour. Really good job, guys. So if I could just say, ladies and gentlemen, while we have reached our time limit here, unfortunately, we do have to wrap it up. It was very hard. I could not get to all the questions. I did try my very best. I would also like to thank all the partners that contributed to making this event possible. And a quick thank you to our events team for working so hard as always to produce this event. In addition, I would like to give a big thank you to Laura Ortu from the Cambridge Judge Business School, as well as Ronnie's fantastic team, Samantha and Yael. On behalf of everyone on this session, a heartfelt thank you to our panel, Michael, and most importantly, Sir Ronald. Gentlemen, thank you very much. Mike?
Thank you all, Navin and Mike.
Yeah, thank you, Navin, for all of your hard work and everybody that helped us publicize. And thank you all for attending. And please, close your laptops and turn your computers off or switch over to something else and think about how we can all make giant steps, baby steps, just something we can do today, tomorrow, next week to start moving this ball forward a bit, because it takes people like us to start the momentum that carries over into people that don't even know what ESG and impact investing is yet. That's the key.
And if I could make you all aware that I have dropped the price of the ebook on Amazon to $2.99 so that everybody can afford it. So please read it, post reviews if you like it and you agree with it. If you agree with what we've said today, you'll agree with what's in it. The best thing we can do today is to spread these ideas.
Absolutely. And here's what the book looks like again. Highly recommend it. And by the way, the royalties go to support impact investing. Sir Ronald doesn't get any of the royalties. I wish we could, ask him for members to receive a discount or something like that on the book. But I think $2.99 is a most definitely a fair price, and knowing that the revenue and the royalties go towards ESG and impact investing and making the world a better place. So please, highly recommend it. And Ronald's website is impactrevolution.com as well. So please check that out. And again, just move everything forward on this. But thank you all. Thank you so much, Sir Ronald. It's been a great pleasure and a very informative. And we're heavily in debt to you for your time today. So thank you
very much.
Thank you. All the best.
Okay. Bye-bye, everybody.